We're going to talk about a three-step plan today on how to handle your RSU compensation. When we talk to clients, we find this is one of the stumbling blocks for a lot of our clients is just kind of frozen in fear about what to do with RSU stock compensation. And today we're going to talk about a three-step plan on how I think clients should handle that and how we instruct and walk our clients through the process. The first step in your plan is to determine your level of risk tolerance. And that sounds like a complicated exercise, but one way to think about that is to determine, what you would feel like if the stock doubled today. How many shares would you want to hold? Well, the answer is a lot of them, like all of them, right? If we knew it was going to double. The other part of that exercise is, how would you feel if your stock price went down to $1 or it became worthless? How would you feel that you didn't sell some of those shares today when they had value versus tomorrow when they might not have any value? So, going through those kind of thought exercises can help you determine a level of shares that you feel comfortable taking a bet on, because really, this is kind of like gambling. Now, the stock market in general, if you own a broad group of, diversified assets, we hope that that just goes up over time. History has taught us that it does. But when you hold one stock, I liken that to the roulette table. You've kind of taken a spin at the wheel. Sometimes it works out, sometimes it doesn't. So no matter how good you might feel about the company having worked there, history is kind of littered with examples of situations where everybody felt good until the last minute, and the company stock dropped, to little to nothing, or went through a bankruptcy proceeding. So you go through that exercise and determine how many shares you're comfortable with holding. Keep in mind at the end of the day too, I mean, not only is a part of your wealth tied up in that company, but if you're currently employed there, part of your other income is your salaries and wages as well. So just keep in mind, if something happens to that company, kind of got a double whammy there. So keep that in mind as you're setting your risk tolerance. If you happen to be holding more shares than you feel comfortable with, and honestly, this is a vast majority of the clients that we talk to, then one of the quickest ways to start to right that ship is to sell additional RSUs that are vesting. So if you're continuing to receive grants, they're vesting over time, and you're owning more and more shares as time goes on. Sell those shares as they are, becoming vested. A lot of times clients are scared to do this because they're worried about the tax consequences. And here it's important to back up and think through how this impacts you from a tax perspective. And the important thing to keep in mind is that once those RSUs vest, whatever the value is on the day that they vest, that is becoming income to you at ordinary income rates. And that means that that income is treated really in a lot of the same ways that salaries and wages are as well. So you've already received the income related to those shares on the value that they were worth on the day of vesting. And therefore, if you were to sell those shares immediately, either that same day, the next day, that week, assuming the stock price doesn't change a whole lot in between the vesting time and the sale date, you wouldn't have any or little to no additional tax consequences related to that sale. That's an important part to keep in mind, and a lot of times clients are unclear about that, but you can go ahead and sell those shares with not much additional impact in most cases. So that's step two. Kind of stop the bleeding. Go ahead and sell those shares, the new ones, as they're coming on board. Third step, now we've got shares that we've been holding on to. So you've got RSU shares that you need to develop a plan for. And let's say you still have more shares than you're comfortable holding. I would encourage you to put together a plan for how to sell those shares over time. And this is where things become a little bit more complicated. And if you're not familiar with your tax situation and how capital gains work in relation to that tax situation, this is where it's helpful sometimes to have a tax advisor on your side that can help walk you through this. But some things to keep in mind. One is if you have a lower income year relative to other years, that can be a good year to sell stock if there is a gain. If you also have capital loss carry forwards, you could also look to sell a number of shares to help utilize those capital loss carry forwards. So those are some of the things we look for when we're advising clients there. Otherwise, you just might be in a situation, well, there's just going to be some capital gains and we just have to deal with that. If you expect your income and tax situation to be relatively the same over a number of years, other than the RSUs, your tax situation's not terribly complicated, then it's really just a matter of deciding, how quickly do I feel like I need to sell these shares in order to diversify my assets? And um, am I comfortable taking that tax hit all in one year versus spreading it out over a couple years and kind of taking advantage of the time value of money? That's a very personal decision, one that you'll have to make on your own. But 9 times out of 10, what we're determining for clients is, perhaps they just don't sleep well at night given the number of shares they own. So developing that plan and having it in place and knowing when you will sell those shares can help you sleep at night, regardless of the tax impact. So as a caveat to step 3 there, when you do sell those shares, be sure that you are setting aside some money for taxes. Capital gain is going to be calculated based on the ultimate sales price minus what we call the cost basis. And the cost basis is really just the value, for RSUs, it's the value of the stock when it vested. You should be able to find that in reports within your custodian's system, and be looking for something that says cost basis. So that's going to be your capital gain. You could be subject to capital gain taxes anywhere from about 15 to 23% on the federal side, and then add your state tax rate to that. Once again, so that's just computed on the gain, not the whole sales proceeds. Make sure you take into account your cost basis there in that capital gain computation. So just make sure you're setting aside some cash. The last thing you want to do is spend that money or divert it somewhere where it's harder to get at, and then come April 15th, you've got a larger tax bill than you expected. For our clients, we're doing that tax computation right now, and we're helping clients get ahead of that. So if you're worried about a situation like that, you're unsure what your tax situation is going to look like come April 15th, feel free to reach out to us. That's why we're here. We do tax projections for clients all the time to help them from a cash flow budget standpoint, and we'd be happy to help you out as well. All right. Hope this was helpful for you, kind of developing a framework of the 3 steps that you can take to diversify your RSUs.